This is RateSpy TV, your covert source for Canada's hottest mortgage deals, strategies, and market intel.
Welcome everyone. You have initiated the launch sequence for RateSpy TV. We are on one glorious mission here, and that is to educate, give it to you straight, and get you a better rate. Now, I'm your not-too-secret agent, Rob McClister, and today's show is made possible by IntelliMortgage, the easiest way to get a mortgage online. Now let's open our files on this week's mortgage happenings. Big city home prices are running hotter than a NASCAR engine. We'll break down the mortgage ramifications. There's a new way to check if your mortgage broker has been caught breaking the rules, but what doesn't it tell you? And like clockwork, the Spy has the quick and dirty on this week's rate deals and trends. Our lead story is home prices gone haywire. Toronto area values have just rocketed 33% in the last 12 months. Now, prices in BC's lower mainland have surged 14%. Nationwide, overvaluation is not a problem, with prices up only about 3.5% year over year. And some markets are actually down. But in the two richest markets, the worry is that what goes up too high, too fast, will drop just as quickly. Now, that and affordability concerns of politicians scurrying like scared mice to impose new rules and slow the market. Now, even bankers are asking for more rules, and when bankers and politicians work together, then you know something's wrong. Now, Scotiabank's Canadian banking head called persistent double-digit price gains unsustainable and unhealthy. And BMO's not beating around the bush either. It flat out calls Toronto a bubble. Now, BMO argues that building more homes to address supply concerns won't solve the problem fast enough. It says only steps to control demand can offer near-term relief. Now, if things don't simmer down by summer, you can bet your tail feathers that Ottawa is going to be looking at new rules to cool housing demand. Now, the Feds still have a cornucopia of options to restrict the flow of mortgages. We're talking things like lowering debt ratio limits, going to a flat 10% down payment, requiring 25% down to avoid default insurance, or raising credit scores. If none of that works, the Department of Finance might just make you post your kids as collateral. Now, for consumers, this epic run-up has mortgage implications. For one thing, it's getting harder to get approved in places like Toronto. Now, assuming you can still come up with 20% down payment, a 33% price increase means that you'll need over 30% more income to get approved. Now, for someone buying the average GTA home with 20% down, that's over $31,000 more income required today versus last year. Now, as Captain Obvious would note here, soaring prices also mean more expensive mortgages. Now, not only is the interest cost greater on a bigger loan, but due to price increases, a 20% down payment a year ago might only leave you with 15% down today. Anything less than 20% down, as you probably know, requires default insurance, which the government just raised the cost on, by the way. On top of that, properties over $1 million can no longer be insured. Now, that's creating a stampede of into homes priced between $700,000 and $999,000, according to realtors. And I think we actually have a video here, a live video of GTA home buyers running to put in their offers. Now, even Canadians buying million-dollar properties with 20% down are not left unscathed. They're now paying higher rates thanks to federal policies that reduced competition from non-bank lenders. And one last observation, needless to say, many Canadians have seen their equity soar. Now, that's created a greater temptation to take out big, fat lines of credit for future spending before home prices fall. Now, knowing this, of course, lenders are being extra cautious in places like Toronto and Vancouver. So if you want a large line of credit, especially if you're telling the bank that it's for investments or you're not drawing from that line of credit at closing, then you better expect your lender to ask more questions today. In other news, regulators have made it easier to find rogue mortgage brokers. The Mortgage Broker Regulators Council of Canada has created a new database for searching disciplinary actions against brokers. You can check it out by clicking the link on the right. It lists license suspensions, administrative penalties, cease and desist orders, all the stuff you probably want to avoid when choosing a mortgage broker. Now, keep in mind, Canada has over 23,000 brokers, and only an itsy-bitsy 1.3% of them have ever allegedly done something bad enough to wind up in this database. Now, of course, there are smaller infractions as well that regulators never ever make public. But again, this applies to a minority of brokers, and those violations are more like speeding tickets than armed robbery. Now, curiously enough, there is no similar database for mortgage specialists at the banks.
How convenient.
Given CBC's expose on bank sales practices, we know the bankers are about as impervious to wrongdoing as Lindsay Lohan is impervious to alcohol. Unlike brokers, there's no practical way for the public to find out if an individual banker has been cited by their regulator. Now, if you want to find out if your banker or credit union rep is shady, you basically have to ask them. Now, by the way, if you have run into a bad broker or banker, RateSpy has compiled a list of sites to file your gripes. Click on the link to the right to read more. It's now time to hop in our unmarked car with our fake mustache and 1970 shades and do some rate surveillance. Now, after making a 2-year high a few weeks ago, yields have collapsed like Donald Trump's approval rating. They're now near a 2-month low, and that's thanks partly to the Republicans' epic fail with healthcare reform. The market figured, heck, if they didn't pass the thing they've been working on for 7 years, maybe they can't pass anything, including economic stimulus.
Winning.
Now, this in turn implies employment and inflation could remain lower than expected. And that, my friends, is bearish for bond yields. And by association, bearish for Canadian mortgage rates. Now, looking at the chart, we need to see the 5-year yield break above 1.33% for fixed rates to rise further, or fall below 0.99% for them to fall. As for prime rate, it's at a standstill at 2.7%. Now, economists predict no movement in prime for the rest of 2017. And now, of course, as we know, economists' forecasts are about as reliable as a screen door in a submarine, so take that for what it's worth. Now, bond traders, they know a little bit more about what they're talking about because they back their bets with real money. And as of today, they're implying a 36% chance of a Bank of Canada rate hike by December. Now, that's due, of course, to Canada's improving economic fundamentals, in case you haven't noticed. And whatever the case may be here, none of this screams lock in. So if you're in a variable rate mortgage, ride it out. Unless, of course, your budget risks imploding from the threat of rising interest rates. It's time once again for the Stars and Dogs segment. With bond yields dropping, 5-year fixed rates have improved by about 10 basis points in the last 10 days. Now, with rate hike probabilities now higher 1 to 2 years out, and given the low break-even rate of today's 5-year fixed mortgages, that makes the venerable 5-year fixed mortgage a decent value for all but the most financially secure borrowers. Now, HSBC's 2.49% rate is still the star of the 5-year market if you have 20% equity and if you don't care about its potentially high penalty and collateral charge. Now, if your mortgage is insured, however, you'll find the lowest rates by far in the broker market. Insured 5-year rates are now in the 2.24% to 2.39% range. Now, just be sure to ask about any restrictions because some of these rates are what we call low frills mortgages. And that often means save more now, pay more later. So that brings us to this week's Dog Pound. It's the same old story this week. You want to avoid any terms over 5 years like a swarm of bees. The cost of a 6, 7, and 10-year term is just too high for the extra rate protection you get, even though you can break those longer-term mortgages early after 5 years with just a 3-month interest charge. Now, another dog is any variable rate above 2.15%. Most uninsured variable mortgages fall into this category. Now, remember that rates are usually lower on insured mortgages. The problem with these higher-priced variable rates is fourfold. Number one, you won't benefit enough if rates go down. Banks are getting stingy with passing along prime rate reductions. Number two, you have exposure, of course, if rates go up in a variable. And number three, the break-even rate isn't good enough compared to longer terms. And finally, you can find 2-year rates for a fair bit less than a variable these days. Now, of course, as the SPY preaches endlessly, the best term depends on your 5-year plan and your risk tolerance. So always balance the flexibility and upfront savings of a short term with the payment security of a long term. Alas, our time is up for this week. We're thankful that you joined us because we'd be pretty lonely otherwise. I'll be back here in 14 short days with more wholesome rate goodness. Until then, don't settle for a good rate when you can get a great rate. Every basis point counts, so the SPY is going to keep watching out for you.
RateSpy TV is sponsored by IntelliMortgage, Canada's mortgage rate search engine.